Hey everybody, this is 𝙈𝙀𝙊𝙇𝙍 with 𝙂𝙆𝙋𝙍𝙊𝙎. It is Tuesday, December 14th, 2021. Very big economic news today that I want to get to. The producer price index printed at 9.6% today, which is the highest on record. I'm going to take you straight to the story. Wholesale prices measure rose 9.6% in November from a year ago, fastest pace on record. The pace was even faster than the 9.2% estimate that people thought it would be. So that's very, very high. So I'm going to explain what that is. You can see the story here on CNBC. This is huge. The PPI, or the producer price index, are basically wholesaler prices. It's what the producers pay to make their products, essentially, or it's how they're raising their prices based on what they pay. So if you look at the supply chain for a moment, you have the raw goods come in. That's the commodities and the commodities producers and the refiners and all that. Product moves down the supply chain to the producers. They produce it, and then they offer a price to the wholesalers. The wholesalers take it and sell it to retail. And that's how the supply chain works. Now, we've said since the beginning of the year that we're going to have higher prices this year because of the money printing last year, which will eventually lead to higher prices. When you have more money chasing the same amount of goods, or more money created than the increase in the amount of goods, or the gross domestic product, if you will, you're going to have higher prices. It takes a while. It started in commodities prices. We talked about that at the very beginning of the year. We started to see higher prints in the producer price index all year. We've talked about it and talked about it and talked about it. Then we've seen 5 to 6 months of raised consumer price index, which is the government's official measure of consumer prices. Now, we believe consumer prices are higher than 6.2% year over year inflation, that what the government says in the CPI, or the CPI light, if you will. We follow Shadow Stats and the work that they've done, and it's in the double digits. That being said, when you see it in the official numbers, you know it's high. So what is the significance of now the producer price index, that PPI, this number that we're talking about, being 9.6%, the highest on record? Okay, and if you use the measure prior to 2014, it actually would be something like 13 to 14%, but forget that for a moment. The official print of 9.6% being higher on record. It means that you guys and me and what we buy at the store is about to get more expensive. Why? As producers raise their prices, it gets passed along the chain. The retailers have to raise their prices. What you have to understand is they can't absorb all this price increase themselves and give it to you at no increase. They have to raise their prices, especially grocery stores. I used to work in a grocery store. Our margins were around 3 to 5% every year. We're lucky if we could pass on any savings to our consumers over what the wholesalers give us the product for. You really have to work to cut those prices down. And so when you see the producers with higher prices, especially in things like energy, food, clothing, those critical goods that don't have super high margins, what happens is they have to be passed to consumers. So because we have a 9.6% print for the producer price index, it's going to raise the prices that consumers pay in the coming months. Now, it usually takes anywhere from 20 to about 60 days for that to come through. But on this high of a print, the highest print ever, I expect the prices that you are going to pay for everything is going to go up right now. In fact, for things that are traded in the futures market, like soybean futures, food futures, hogs, cattle, stuff like that, also raw goods futures, those prices are going to go up immediately because people are going to see the PPI print and they're going to raise the futures prices immediately, okay? And that's going to raise all prices across the market. But what you're about to pay at the grocery store is going to get more and more expensive. Now, what does this mean? I think because the PPI, what the producers are paying right now, is 9.6% from November of this year to November of last year higher, we're going to hit double digits. I don't think we're going to hit it this year. I mean, we could hit a double digit producer price index this year and not hit a double digit consumer price index, because it does take a little bit of time for those prices to be transmitted. And we're looking back over time, but it takes about 30 to 40 days usually. But I think in 2022, we're going to see double digit inflation, real inflation of prices you pay for goods and services as measured by the government. I think we're already at double digit if you look at real data, but as measured in the government, you're going to see double figures. Now, why is that significant? Because when you see an official government number move from a single digit to a double digit, psychologically in the market, that is huge. It's going to affect expectations for the stability of the currency and prices in the economy for everybody. one of the first places this is going to hit is the bond markets, because the bond markets look at economic data. Bond traders are some of the smartest traders in the world. It is a huge market. They look at more data than do stock traders. Bond traders see risk first. You're going to see a change in bond rates. Yields are going to have to rise. Also, the expectation of bond traders is that the Fed is going to raise rates. When the Fed raises rates, rates on those treasuries are going to have to go up to compensate for that raising of the rate and the perceived inflation, right? Because when inflation is high and you're not offering return on bonds, you have to make that more attractive. The new bonds have to come out at higher and higher yields. It means the existing bonds get priced out of the market. They're not worth as much. So if you've got a bond trading at 1% and all of a sudden they're trading at 2%, the bond you have at 1% is not as valuable. The price has to come down. It's going to be losses for savers in bonds as the bond market reacts. Number two, I've said from like the September to October Fed meeting minutes and or press conferences, a lot of the Fed governors were becoming more hawkish, and they wanted to raise interest rates sooner. So we expected in June, July, as of a couple of months ago, that they would begin raising interest rates. I think now with this producer price index rise almost double digits, 9.6%, and what's going to happen to the CPI in January, February, I think that the Fed's going to want to raise interest rates faster. Once you get close to a double-digit print, the Fed's going to have to act. Not only are they going to quote unquote taper their purchases, I think they're going to raise interest rates. And what's going to happen is that's going to tighten things up in the liquidity of these big debt markets. It's going to make everything more expensive, not only your groceries, it's going to make investing more expensive. It's going to make the cost of labor and goods for companies more expensive. We're now in a cycle where everything's going to spiral up and get more expensive. And the question is, are your investments going to keep pace? I think there will be one more stock melt up, okay? And then it'll crash because it can't be supported, because the valuations can't be supported. I think bonds are going to get a safe haven bid, and people are going to go in for the higher rates until they realize the higher rates are due to higher risk. That's going to happen. You're going to see stresses in those markets. You're going to see more people not able to afford basics like rent and gasoline and groceries and things like that because the prices are going up, and it's going to be risk everywhere. And the entire market in 2022 is going to trade differently in 2021. Are you in the right investments, okay, to deal with this? Now, I was just on this morning on a live spot with Chris Marcus of 𝙈𝙀𝙊𝙇 Economics and Andrew Pollard of BlackRock Silver, and we talked about this. And this is about 9 o'clock this morning, my time. I just got off of that meeting a little while ago, and we were talking about this. And what I said in that live spot on 𝙈𝙀𝙊𝙇 Economics this morning was true. Are you in the right investment? You better take your positions now. And the best position to take is precious metals. Precious metals, especially gold, but gold and silver, will hold their value in a rising price environment and in a risk environment. They're the best investments to make, bar none. And I'm not giving you financial advice. I'm telling you what I would do. I believe precious metals are the best. You have to make your own decisions, do your own research, consult your financial advisor before doing anything. Don't listen to me, okay? But at the end of the day, I believe precious metals are the best protector against this rampant inflation that we're going to have, and the risk on in the bond and the stock markets that now officially is going to occur in 2022 and is going to start being acknowledged by the mainstream financial press and by the big hedge fund traders and those guys. You're going to start seeing more of this talk come about in 2022. It's going to be a theme. Okay, if you position yourself in precious metals like I am, it takes a lot of that worry away, because that's what's going to help you survive through it. The other thing is going to be the undervalued but premium performance mining stocks. I'm revamping our mining stock tracker for those of us that support us on Patreon at that level, the mining stock tracker level. I'm revamping the companies I already have. I'm going to add a bunch of companies. By January, I will have a full new curated list. The existing companies that I like are going to get updated, are being updated. We're going to have a full list of new companies, and I'm pushing off the companies that haven't performed as well. We'll have that for you. We're doing it right now, but we'll have it finalized in January. So those of you who are interested in the mining stocks, we have a mining stock tracker. You can support us at that tier of Patreon if you want. We'll give you that information, and that will help you. Why the mining stocks? Rob, aren't they risky? Aren't they all? No, they have risk, but when you have a cycle change like this that I've been talking about, and there's rotation into safe haven assets like gold and silver, the mining stocks are going to outperform even gold and silver because they're leveraged to that price. Most miners right now, gold and silver, are in the black in terms of profit. They're making money. It's going to get better as those precious metals prices rise. We're in a massive bull market that's going to start for the miners. Now, I'm not going to tell you the exact date it's going to start. Gold and silver have to get the bid first, and then the mining stocks will follow. Usually mining stocks lag it by a few months, as those profits start to come in and the generalist investors start to rotate to the mining stocks. Because think about it, they're in passive funds. Passive funds get hammered because of bad economic conditions, inflation, rising interest rates. So their returns start to come down. The gloss wears off the general market. The generalists rotate into the mining stocks. When that happens, there's going to be a big boom up in the mining stocks. You're going to gold and silver move first and the mining stocks after. That's how I'm positioning myself. Do your own research. But that's whatever you do, just look at your portfolio ending the year. Take the next couple of weeks going into January. Look at your portfolio. Say, am I hedged against major stock market risk, major bond market risk, and much higher prices for 2022. That's the significance of this PPI print and all the CPI prints we've been seeing and all the commodities prices rising like I've been harping about now for 11 straight months. You heard it here on Gold Silver Pros before anywhere else. Everybody's talking about it now. I've been harping on inflation for months. Now you see all these other YouTubers and influencers come out and start to talk about it. Now you're starting to see the mainstream talk about it. I was first. I talked about this when nobody did. And that's what we do. We look at the data. We're a data-centered approach. We look at the data, I've made tons of predictions over time that have come true. A lot of them still in the process of coming true because I look at the data. You're going to see it here first on Gold Silver Pros. This is a breaking. We talked about in 𝙂𝙊𝙇𝙑𝙀𝙊𝙎 economics. I would have had it early this morning, but I agreed to go on live with Chris. It was that important. Now I'm bringing it to you guys. What's going to happen as a result of this PPI, highest ever 9.6%. You guys leave your comments down below. I'll join you there and we'll get this out on the channel as soon as possible. Thank you guys for so much. We'll continue to bring you breaking news as it happens. We've got our economic calendar loaded right here. Tomorrow, the Fed, big Fed announcement. We'll cover that tomorrow. Stay tuned to that because that's going to tell you how the market's going to react in 2022. The producer price index is out. The CPI numbers have been out for November. All that's out. The Fed is going to tell you tomorrow what they're going to do. We're going to cover that. Stay tuned right here to Gold Silver Pros. You don't need to go anywhere else. Thanks, guys. Thank you guys so much for watching today's video. We appreciate it. Please remember to like, subscribe, and share, and hit that notification button so you get those notifications when new content comes out. If you like what we're doing here, please consider supporting us on Patreon. Those members of Patreon will get extra special content delivered to them as well.